Hey, welcome to LikeFolio broadcast here. I've got I'm Andy Swan, founder of LikeFolio, and with me is Landon Swan, the founder as well.
Hello, I'm feeling pretty good today.
Yeah. Hey, today's been a good day. This is Wednesday, April 25th that we're recording this. I've got the LikeFolio Sunday earnings sheet here, and just ticking through it. We were bullish on Tesla. That was a miss. The stock is down. We were bearish on Citrix. That one's working barely. UPS bearish. It's their biggest down day, I think, in a very long time. So that one's working really well. Visa bearish, I think, is pretty neutral. Xerox bearish is working well. GNC bullish. Um, Nice gain on GNC, even though it's a really low dollar stock. That one came in just like we talked about. And Southwest, nice little move higher. We were bullish. Altria, the cigarette maker, bearish, and they have exceeded the market maker expectation in terms of a down move. So that's good. And Chipotle, we were bearish on, and the stock is down, close to $50 on the day, 7%. After, spending most of after hours yesterday just kind of teasing us and being up a little bit. I was like, well, that was not a great report. Why are they up? But finally, the market kind of came through for us the next day.
Yep. I think we almost got them all today. Tesla's the only one that we missed. And I think Visa was kind of a break even, but the rest of them went our direction, like 8 for 9 or something like that.
Yeah. Yeah.
Good day. And it's a good week overall. I mean, we've been hitting it this week. And I think there was like 30 picks this week. We've done very well so far.
There's still 10 more.
It's ridiculous.
There's still 10 more that have to be entered today for either after market today or before the market tomorrow, including one of which is Amazon, which we bolded on here. And we also bolded Discover. But we've got picks today on SkyWest, Ford, Chevron, Mattel, Colgate, Intel, Bloomin' Brands, Grubhub. I mean, the list goes on and on. So if you're not, getting the Sunday earnings sheets, check it out, likefolio.com. We've got a new demo up there right on the front page. You just click, put in your information. We'll send you a demo. It's really cool. Moving on. So Tesla was the one that beat us, and that's naturally the one I want to talk about, Landon, the one that beat us. And so for that, I'm going to see if I can, I'm going to share the screen for those of you on YouTube. Let me see if I can, yep. Okay. Screen 2 sharing. So this is the dashboard of LikeFolio, where you can see all of the, purchase intent mentions, consumer happiness, all that kind of stuff on the stock itself, and the data that we have on the brand. And so what we're looking at right now is just our fiscal quarters view, which is a really simple view, which breaks things down by quarter, by the company's fiscal quarter, which is really cool because that's the way they report. But, for those of you on the podcast that can't see this, I'll just explain. What we've got is just essentially plotting the demand for Tesla cars over time from 2012 through this last and most current quarter. And you can see just this sharp, kind of going parabolic demand curve for Tesla cars. And that tells us that the consumer demand for Tesla vehicles is very, very strong. That's the reason why we were bullish going into this. The stock was very hated at the bottom of a channel around 260. We were bullish because our data is showing, very high levels of consumer demand. But I think the thing that, Landon likes to talk about, Landon, you can talk about this a little bit. There are some limitations to how much our data can tell us in terms of what's going on at the whole company.
Yeah, there's a lot of stuff that goes into a company's stock valuation. And top line revenue is, maybe the most important. And we measure essentially consumer demand, which, obviously ties into top line revenue very well. for some companies, potentially Tesla, that's not the only thing. It's not just consumers wanting the product, is can they deliver the product? Can they make them? Are there any delivery problems? That kind of thing. And so obviously more things go into it like that than that, like cash flow and expenses, all kinds of stuff that we can't measure. But what we do go for is consumer demand. And what we're seeing is like you said, sort of a parabolic move. And actually, this is a funny chart for those who can't see it. The bars are really small until 2016 or 17. They started moving up. And in 2018 and 19, they started going really high. But if you would actually, we don't have the ability to do this, but if you would zoom in into 2012 and 13, that would look parabolic as well. It's just the bars are scrunched down so low because they're so high right now. So relatively speaking, they're very low. But when Tesla was back at $40 before it ran up to 150 into early 2013, we saw the same move. So we're measuring consumer demand and also consumer happiness, which, Andy, you've got a good point about that, which is kind of a little bit of a concern with Tesla.
Yeah, it's a real concern for Tesla because over the same time period, so again, from 2012 through 2019, LikeFolio also tracks these, what we call consumer happiness, which is a measurement of, people showing positive emotion around the company's brands and products versus people showing negative emotion around the company's brands and products. And we map that ratio over time. And, you can see the thing that bothers me about this, Landon, is that since consumer happiness kind of peaked in 2014, 2015, above 80% happiness,
Mm-hmm.
we've seen a pretty steady decline over that 3-year period down to now low 70s in terms of happiness. And you really don't want to see that for a young company. It's still low 70s is pretty good for a car maker, so don't get me wrong. But you don't want to see a decline as more cars go off the lot and get into consumers' hands, consumer happiness dropping consistently. It just tells me that there's the potential that there's an overpromise in terms of what the company is selling in some of its autopilot technologies and some of these other things. There's also possibly some service issues that keep bubbling up in these tweets that we analyze. So that's kind of like one of those yellow flag, kind of red flag things, along with Tesla's debt issues and production issues, is that as this demand ramps up, they are making their customers less and less happy, which is not really a great spot to be.
It could be, it's a great point. It could be, like you said, overpromise, because a lot of this is people, hearing about how great the next one's going to be. It's not out yet, but here's all the cool things that we'll be able to do. And so people, when they talk about those, they talk about, I can't wait to buy the new Model 3. I'm talking about 2017. I can't wait to buy the new Model 3. It's got all these really cool features. I'm buying it. And now they're talking, I got one and it doesn't exactly do everything I thought it would do. And that's just sort of, I think that's a function of Musk's personality. He sells first, and then maybe it's not exactly all the way up to what you expected. People still like it. 70% is very high, like you said, for a car maker, but expectations were really, really high, a year or two ago.
Yeah, and I think for me, I want one. I want a Tesla. I think it's still, I'm not bought into all of the hype on the autonomous driving and this whole concept that next year you're going to be able to turn your car into a taxi, which I don't think I would, a robotic driving taxi without you even in it, making money while you sleep and all this stuff. I don't buy into that, and it's not something I would really probably do, is send my car out there to pick up strangers all night. But I still think that the car is amazing. I don't have to be all the way bought in on all the hype. I just think, I've driven the car. The car's amazing. I want one. I understand that there's going to be some service issues and some flaws. But I'm an early adopter, and I'm used to that stuff. So that's the way I come at it.
Yep.
The other stock I just really quickly wanted to hit on is one that we got right. Chipotle down $50. We've been fighting this baby for a little bit of time now with this new CEO. He's amazing, from Taco Bell, and finally took over for the hippies that were in there before, that didn't know how to melt cheese to make a quesadilla or queso. This guy knows what he's doing. He's from Taco Bell. He can make a new product out of any random 3 ingredients that are in the store. And that's
Yeah.
his bread and butter. Like that's what Taco Bell does. So I'm glad to see him in there.
And
But
if
it's
you
been
give him
tough
one new
betting.
ingredient, he can make 50 new products.
Yeah, right.
He's a
Right.
permutations guy.
Yeah, exactly. That's exactly right. And market the heck out of them, which I think is important. But I think we've been fighting this one because our data has been showing, either flat or slight increase in terms of people going into Chipotle stores for a couple, 2 or 3 quarters now, while the stock just continued to go higher and higher on expectations for this CEO. And so that's one of the things today. Today it's coming through for us. I mean, the stock's down 50 or $60. We're making money. All of our members are happy. But it's one of those things that we constantly have to fight and we're fighting it with Domino's, I think right now, is when a new CEO comes in, there's a honeymoon period a lot of times where Wall Street will look past some performance issues on the top line, bottom line numbers.
Absolutely. And, what's interesting is, our purchase intent for Chipotle has been really predictive of revenue, even while we've been really wrong on the stock. The stock went from, 300 to 700. All the while we're seeing pretty flat purchase intent, which, tells us to be very bearish. But the revenue was agreed with our purchase intent. That just stock market was very high on expectations for the CEO. And eventually he's either going to blow it out or he's going to very heavily disappoint because the expectations are so high. It's sort of binary. I think getting to that point where you 2.5 times the company value, you're expecting 2.5 times company revenue. If you don't deliver, it's going to be really bad. So
Yeah, that
right
is.
now it's looking bearish data on for LikeFolio.
Yeah, I think, and just to be clear, I don't think we were bearish from 300 or 400 all the way up to 700, but we've been bearish in spots and just had it kind of either flat or not work out a couple times. Now this one is working, and I think, when you finally get one that works and it's kind of gives you that clue that the honeymoon's over, baby, then that could be the
Right.
start of something. That could be the start of something in terms of a downdraft for the stock.
Yep.
Uh, um, so that's that. I think we're week 2 into earnings season out of 10. So I mean, we're just getting cranking, and this is awesome. Um, eh, One thing I wanted to talk about, because I know so many of the people that listen to this and so many of our members use options, and especially option spreads, to trade earnings, which we highly recommend because it's a fantastic way to limit your risk to a very defined small amount on each trade and allow you to trade 10 trades overnight like this. So we really recommend doing that. But one of the things that I think gets lost on people when you're doing an option spread, Landon, is you've got a lot of times you've got multiple legs on this. So you're actually executing multiple orders in one order.
Mm-hmm.
And so price is not as clear cut as it is on a single instrument. And so can you talk to people about how you like to enter orders or exit them, and this concept of working your order?
Sure. So I think that I'll limit it to verticals, which is when you're buying a call or put and then you're selling a call or put at a different strike price. And the difference between those is your fill price. Sometimes you're getting a credit, sometimes it costs you money. It just depends on which way you're going and which side you decide to use. But as far as the filling the order, I think there's 2 sort of phases to it. So the first one is selecting which strike prices and which months you want to do. I think strike prices are probably the most intuitive because
Yep.
if the stock's at 100 and you think it's going to stay here, maybe go down, you're going to buy the 105 put and sell the 100 put, something like that. Like, it's not really difficult to pick the strike prices that fit your mentality. But then I think one thing that a lot of people do, even experienced vertical options traders, is they just assume that the month that they're looking at is the one to do. Like, the next month is the best thing. So what I will do inside the Thinkorswim platform is I'll load up my order for the front month, the next month that's coming up, with that unlocked price, right? So the price moves with the market, and I'll pick my strikes that I like. And then I will just go in that order editor and change the month and go from that strike price to, if they have weeklies, add 1 week to it, take a week away, just kind of play with it and see what happens on that price. And what you'll see is every once in a while, there's a price that doesn't make sense it seems too good to be true. Like it's a little bit off, you know, like if you add a week, it adds a nickel, adds a nickel, adds a nickel. The next one's like the same price as the one before it. Like, ooh, that's a good deal. I want that one. So that's often how I will pick it. So I think just selection is the first way to get a great fill, because you're starting off where the market's on your side by, 5 cents or so.
Yeah,
And that
and
doesn't sound like a lot, but if you do that every time you trade over the course of a year, that's going to be a lot of money.
yeah, and and the way that I think about it too is not just that you saved 5 cents. It's that you gained a week, or maybe you've bought very cheaply an extra month of duration on this trade, which
Right.
doesn't seem like much to you probably when you're entering it. But believe me, when you get to that, you get 30 days out from now, and one would have been expiring, but now you've got another month because you paid an extra 6 cents for the spread. Like that could be a massive difference in your profitability. And so you're buying time by doing that, by doing your diligence in terms of month selection, like Landon's talking about, or expiration selection, and going through and just looking at where this thing starts to where there's maybe a deal. You're buying time, you're buying duration, and sometimes that can be a really big deal.
Yep. So that's sort of like phase one, is the
Yep.
selection of the trade that you're going to try to do. The other thing that I like to do is, like I said, I have that unlock, the price is unlocked, so it sets it at the midpoint. And I will, before I enter the trade, I will click in my direction at least a nickel, just depending on how big of a, spread that you're talking about. And I'll submit the order, and I almost never get filled. If you do get filled right away, you didn't have a good price. You're like, oh, shoot, they took me on that, right?
Yep.
And so, like in a situation where we're doing earnings trades and we're doing 10 a day, like I did 10 entries today, 10 entries yesterday, I will go through and I will select each one of those and submit an order with that, selfish kind of price where I want to pay a little bit less or get a little bit more credit, whatever side I'm doing, by a nickel or so. And I'll put all 10 of those in, and they'll all be working. And then once I put all 10 of them in, I'll go back to the first one and I'll raise it by a penny. And then I'll go to the second one and raise it by a penny, and just keep going. And as you get closer and closer to the market price, you'll start to get fills. And then you can save a little bit of money here and there. You save a penny, save 2 pennies, whatever it may be. But just making sure that you're actually getting the best price by walking it up slowly. And the other thing is, you don't have, like, if you want to get in today, I would start at 10 o'clock in the morning Eastern time, half hour before the market, half hour after the market opens. And then you've got 6 hours until the close. You don't have to get in right this second. Let them work for a while. And then start walking them up, whatever you think. So it takes a little bit of patience and discipline to do it that way. But again, if you do that every time, every trade, you're going to save a lot of money over the long term.
That work pays off. And it's essentially, if you think about it, we're always kind of comparing things to blackjack or gambling. And it's kind of like, learning that you should double down on 11 versus 20. It's kind of like learning that you should split eights against 4, 5, 6, that kind of thing. Like learning those things and doing them, it increases your odds in such a phenomenal way. It seems small at the time, but if you can save 1 or 2 cents on every option spread that you get in for $1 to $2, you've just increased your your odds of winning on every single coin flip that you make by 1 to 2%. I mean, that's an enormous deal. It's really big deal, and especially over time, it really adds up.
Absolutely. Yep.
The only other thing I would say on that, just to add a little bit, we call it price discovery. And that is, if you're looking at entering an order with, let's say instead of 1 options contract, you want to do 5, or you want to do 10, or your account's big enough, you want to do 20. The best way to do that, the most diligent way to do that, usually is to put in the order for 1 contract first and do exactly what Landon's saying. Find the price where they're actually filling the order, because a lot of times it's better than the advertised price. And find the price where they're advertising or where they're actually filling the order, and then go ahead and put in your other 4 contracts or 9 contracts or whatever. And so use a one lot to do price discovery so that you don't get surprised when you put in, let's say you're doing 10 contracts. You don't want to put in 10 contracts and get filled instantly and realize, oh my gosh, I probably could have saved 3 cents per contract here, which adds up considerably over time.
Yeah, $30. Yeah. So, yeah, absolutely. And that I would just kind of mirror that. If you put an order in and you get filled right away, you did something wrong. And it should it's like if you're at a car dealer and you're used car dealer and you make an offer and he shakes your hand right away, you're like, oh,
yeah,
that's not good.
Yeah, that's exactly right. And the caveat there, look, sometimes it is what it is, and it's 350 or 355, and you got an opportunity to get into something before earnings come out, and you got a limited amount of time. You got to take your lumps and just get the order done. I get it, but there's a reason why it's called working the order, and it is a little bit of work, and I think it pays off for people that do it, and the people that don't do it are the ones that are contributing to our overall alpha.
Right. That's a good point. Yep.
All right, cool. Well, that's it for me, Lane. You got anything else for this particular show?
No, I don't think so. Just keep your risk, stay risk defined, let it work for you over the long term. That's key. We'll preach that forever.
How much more can we do? We got 10 orders working right now. We got to get back to work. They're working our orders. All right, guys. Great stuff. Follow us at LikeFolio on Twitter or in any of the podcasting apps. Just search for LikeFolio or on YouTube. Make sure you get every one of these. We love chatting with you guys. Andy at LikeFolio.com if you've got feedback, or Landon at LikeFolio.com if you've got feedback. We'd love to get it. Make this show as good as it can be for all of you.